A yield curve is a graphical curve showing the yield on one type of security ranging from a period of short-term 3 months out to 30 years. Typically, in a normal interest rate environment, this curve is sloping upwards from the left towards the right. In other words, short-term securities will have a lower yield on them than longer-dated securities, which will have a higher yield on them. A yield curve with a very steep slope, an upward-sloping yield curve, will probably predict that short-term interest rates will rise in the future, because the difference between short-term interest rates and long-term interest rates is too large for investors to accommodate. When talking about the bond market, it's important to know who the investors are in the bond market. Aside from individuals such as you and I, there are also large investing institutions such as pension funds and insurance companies. And this makes a big difference to the return for these two particular segments in the marketplace. Because after all, what investors are looking for in the bond market is their after-tax, after-inflation real rate of return. How do investors invest in the bond market? Do they hold the bonds to maturity, or do they trade them actively throughout the period to maturity? Well, that depends whether you're a holder of short-term bonds or long-term bonds. Many conservative investors will have a laddered portfolio of bonds, which means that they have bonds coming due every year for the next 5 or 10 years, and as they come due or mature at par, the proceeds are reinvested at whatever current rates are. Some investors, more aggressive investors, tend to trade longer-term bonds because there's the opportunity for capital appreciation, and the price volatility of longer-term bonds is more extreme. There's one other component of fixed income investing that's worth mentioning, and that's called credit spreads. There's a difference between the rate at which a corporate bond trades over a government bond. For example, the highest credit you can get in the bond market is the Government of Canada, which has a AAA credit rating. Spreads over the Government of Canada credit vary for different types of corporations depending upon their level of creditworthiness. And credit spreads generally move wider or narrower depending upon conditions in the financial markets. For example, right now, because the Bank of Canada has been lowering interest rates, Government of Canada bond yields are particularly low. However, other borrowers in the marketplace, be they banks or corporations, are having more difficulty acquiring credit facilities. Consequently, they have to pay a higher level of interest rates to attract investors into their securities. And so right now we're finding that corporate credit spreads are significantly wider than the government yields than they have been for a long period of time. Just to give you an example, banks have to pay about 75 basis points or 0.75% above what the Government of Canada would have to borrow for a 10-year bond right now. If we turn the clock back about 18 months, banks and other corporations were only paying about 40 basis points over what the government was borrowing at for similar term securities. I've mentioned a multitude of different dynamics prevailing in the fixed income markets, and it's the interplay between these dynamics that make fixed income investing challenging but also highly rewarding.